talking about the news earlier on,
Yeah.
and everyone's like the impactful news, is that if you look at in the hedge fund market, you've got real money. This pen's going to run out. Right. What does real money mean?
Like proper capital.
Proper capital,
Yeah.
unleveraged.
Yeah.
Okay, so if you've got £20 million, for example, you're going to probably trade with £20 million. You don't really want to leverage it. You're just going to use the £20 million to run with. Then you've got hedge fund. Okay, so right, Finn, what's a hedge fund?
Citigroup raised the price of Oracle to
Okay, but what are they going to do with it?
$96.
Increase their capital.
So effectively, they might put say the 20 million down,
Yeah.
but they're probably going to get 10 times the leverage.
Yeah.
So effectively, they're going to create themselves like a £200 million like trading account.
Yeah.
Okay, so it's 200 million. So it's the same amount of money, and then you've got the corporate. Right, so you've got the corporate, which has basically got stuff to do every single day. Now, in the banks, we will all trade with these people. Like, you know, obviously I haven't been in banking since 2008, but I traded with all these guys. The real money people would come in and they would just trade their amount of money, but it's real money. So it means that, I mean, and obviously 20 million would be small. You know, you might have a billion pounds or €1 billion or $1 billion will do. The hedge funds, you didn't know, because I'm using 200 million there because we're putting a number on that, but they could have 2 trillion. And so their amounts are going to be huge. Right, okay, and they run models over all this period of time. So and the corporates have got, like for example, somebody like a BP, right, we use that as a corporate, they used to once a month do a trade where they used to sell sterling and regain dollars for something they wanted to do. I think it was paying dividends, etc., etc. So they used to do this trade once a month. They used to sell a humongous amount of sterling. Could be like $1 billion, but they'd do it in a very, very quick time frame to try and impact the market, which meant that the traders would make money. They've since changed that, and so what a lot of them have decided to do around about, I'd say around about 2000, is they'd usually just do their trades when they wanted to do them. They decided that they weren't happy with probably the service they were getting from the banks because the banks were reading them. So they created little moments in time, which they called fixings, that meant that what they'd do is they'd say to the bank, I'd like to sell, say, £200 million, let's use sterling as an example, but I want to do it at the 4 o'clock fixing. And what the 4 o'clock fixing was a point in time, and it used to be exactly at 4 o'clock or within a 30-second period, and they used to get the mid rate. So if say for example, cable was trading at, say, 135 at exactly 4 o'clock, but it went to, and they were a seller, but it went to 134.70, whatever the mid rate would have been in 30 seconds, so they'd work out, say it came in at 85, that would be the rate that particular customer would have sold their £200 million or £20 million. And so what you used to see was actually a build-up of movement in and around the period just before the fix. And this was something that traders used to observe. And so what you could see, you go, wow, something's gone out of sync. So all the currency pairs that are related to maybe sterling, we use that for an example, you could see something brewing. And so what that would do is give you a bit of intelligence. You know, like you're receiving the intelligence in terms of news, and then thinking, I'm going to act on that news. This was intelligence within the market. And the reason we're talking about it now is it still exists today. Okay? So it's what it is, it's another tool in the toolbox of a trader that sits there. But what's happened is because people were so aware of the 4 o'clock fixings, they've basically started using different times during the day. And the reason why I've we're talking about on the technical side of it, is that Tom's looking at, is that you can go back and test this. You can go back and look for activity and see what times in a lot of the currency pairs that you're trading. You can look at the things that are just brewing, and you just see, well, why did all of a sudden, like for example, gold, why does gold not move? And then at the moment, obviously the trend is up. And you know, why is the trend up? Why are people buying gold? Do you know?
Because it's a safe haven.
Okay, safe haven for what? What have been the real catalyst for gold?
Crises.
Crises,
War.
wars.
Geopolitical.
Right. Okay, so
Events.
basically at the moment we've got wars.
Tariffs.
If you look at what was going on, tariffs as well. If you look what was going on, say, was it about 3 or 4 weeks ago when Putin met Trump? Where was gold when Putin met Trump? Quite a bit lower than we are today, because people were probably anticipating there might have been some kind of a peaceful solution. Okay, so these hedge funds, real money and corporates that might have interest in gold, will sit there at various points in the day and give their gold orders, but they'll give them for certain timings. They're not going to turn around and the way that systems are turned on and off, they're not just going to go blindly into the market at the beginning of the day and go, I'll buy as much gold as I need to buy to satisfy the fact that I need gold. They pick timings, they go in at timings, and that's the key to fixings. Fixings start at 8 o'clock in the morning. There's always an 8 o'clock fixing in foreign exchange, probably in commodities, and I know they're definitely in foreign exchange. They will definitely be in and around the gold market. You used to have the openings in all the stock exchanges. You know, the FTSE opening, it was always a big what's going to go on at 8 o'clock. And what is it's initial orders that are put into the market at a certain period of time. Now, if you could anticipate what those market orders were, how successful would you be as a trader?
Very.
Because you're always going to have something that you're going to be concentrating on, even if there's no news. So right here and now, the reason why we said about gold is, and what I would say to everybody here is that if you go back and you've got a particular currency pair or a commodity, look at the timings of when these things move. And what you'll probably find is that actually, it's strange, it could be 130, it could be, and then what that does, it will give you a little bit of an idea of where you should be positioned in the market at certain points of the time. That doesn't mean to say you're going to hold these positions. The way we used to trade fixings, it was just impact. So it might be not a trade that you'd ever want to put on, but you'd just be aware of where these were going to be. Like, for example, if there's going to be a massive sterling 4 o'clock fix, we would just want to be short sterling. But as soon as that 4 o'clock fix came around, you're out. You've made your money.
3 minutes now.
Even if your bottom line was that you wanted to be long sterling, you know, you'd only be there for the impact of it. And so on the fixings, that's, if I was advising anybody on fixings now, I've spoken to Brad quite a bit about this as well, is that what you've got to do is do your research. Look at the timings of the moves. Because if you're concentrating on news, the timings of the move could be any time. You know, you look for a piece of news to come out, and you act on that news, and it's an impactful trade. You're in, you're out, you take advantage of the news, which is what everybody's doing. It's a very, very congested space, but 100%. Some of these hedge funds, for example, they're called momentum, and what momentum is part and parcel of a system that will trade the momentum of a certain move. For example, so gold's just got momentum on the top side, yeah? So if you're a momentum trader or a momentum fund, you can only buy gold, right? Because you have new money coming into your fund all the time, and the model says buy gold. But as soon as that momentum runs out, it goes the other way. And that momentum, when's the momentum going to run out? Some idea that we're going to have some peace somewhere in the world. You know, that all of a sudden, I mean, we just had the big meetings. The reason why gold's carried on going up is we had meetings in China last week that sort of alienated everybody else in the world and put Putin, India and China and North Korea all in the same room. You know, that probably take India out of the equation because they're quite peaceful, but the other three, you know, they're the ones with the nuclear power to upset the world.
All four of them are nuclear powers.
Well, they are nuclear powers, but India's pretty peaceful with the West, but it buys its oil from Russia.
Yeah.
And so that was basically they've been tariffed. I can see North Korea being a bit of a volatile nuclear power, and obviously Putin's got nuclear power, and so is China. But I wouldn't say that India is that anti the West yet to actually use it. But that's just an opinion. But yeah, so what we've got is momentum in gold. So these momentum guys will keep on coming in every single day and buying gold, especially with the latest, if you like, warmongering, geopolitical scenarios that are going on. But when they decide to get out of stuff, they will pick certain timings, and they will pick certain timings to say, right, and they're the biggest movements in the market. When they're anti the trend, it moves big time. Were people around when sterling crashed on Liz Truss? You know, the Liz Truss budget, when all of a sudden when she put out an unfunded budget, 2022, was it the end of 2022? Yeah. Probably, I think it was October 2022. So she basically came out with an unfunded budget, which is the complete opposite of what Labour have done. This was giving business so many breaks, but it wasn't funded by anything. The idea was it was going to fund itself. It was the idea that if business really, really takes off, then the extra tax receipts coming in from the business receipts and the individuals that they were going to employ to grow business were going to pay for it. But the Bank of England didn't like it, and so literally, like, our borrowing costs went through the roof on our debt, which basically crashed sterling. So, for example, these momentum funds, I know for a fact my daughter works for Morgan Stanley, and they had, so I think we were around about 114 sterling, so they were long an awful lot of sterling. Where's sterling today? About 135. So their long-term position was long sterling for a good reason. But this one particular budget that came out completely threw it offside, and they lost billions, right? Because everybody had to sell at the same time, and that's like momentum. It's not necessarily as impactful because sterling went down 12 big figures, I think, in a day and a half, 2 big figures in 2 days, and then it's basically recovered all the way back up to these levels now.
Its cover on the
So when momentum happens, the opposite of the trend. So the trend at the time would have been people would have been quite happy to have been long of sterling, looking for a view, and this is coming from a big investment bank, you know, a big US investment bank. Everybody has to do the same thing, and so their momentum wouldn't wait for a fixing; it just gets out. So.
And they sell
If I'm going to recommend to everybody, if you want to try taking a look at the fixings, go back and do your research, look at some currency pairs, look at some commodities, look at the timings of when they move, and you're going to find a little pattern emerging that at certain times during the day, and that's going to make you, and then look at it, follow it, watch the money, just turn around and try and find, wow, every single day there's some kind of a movement to one side of the market that a lot of the time will reflect the trend. Sometimes one, and when that happens, that will be the bigger movement. But then if you can backtrack it and you can back test it, then what it might do is give you another tool in your toolbox for trading, which won't be then reliant on sitting there possibly just waiting for news to come out, because that's one thing. But most traders in banks will have so many different tools in their toolbox rather than just one thing. I mean, I can give you an example. I spoke to Brad about it. There's not any of this impactful news that you guys think is impactful. None of these hedge funds are going to trade on that unless it's absolutely impactful, which is why you see a lot of these, we've spoke about it, but even trading it the other way round, that you can't get in, but then it hits a level, then it goes all the way back up to the same level. I mean, how many times do you see that happen? Where you basically see, well, there you go. So if it's close to 100% of the time, because these hedge funds and the real money and the corporates aren't interested. You might think they are, they're not. This is something that's come about from the retail. It's giving the retail market something to do. News impactful. So for example, me as a trader, when I'm trading, if I'd have seen like the retail guys all selling on a particular news item, I know that that's not, it might be an impact news for 30 seconds, a minute, 5 minutes, but it's not going to affect the market. These guys don't trade like that. They've got so much money in the tank that they're ready to trade. They will sit there, they will analyse it, unless it's absolutely impactful, like maybe the tariff news. Like the tariff news is something that's, well, we've got to act, we've got to do stuff. You know, and the market, I mean, I remember talking to Brad about it, I went, well, they've got this wrong, do you remember? They kept buying dollars.
These guys do it straight away, isn't it? Because they're trading such big size.
Well, you can't, so if you've got like 3 trillion, you've bought 3 trillion euro against the dollar, and somebody says something, then I mean, to use the Trump tariffs, for example, if you look at where euro dollar was before then, well, actually, I think we even go back to the election. So Trump gets in, and you've got euro dollar got sold aggressively because everybody thought it was going to be really, very, very good. I looked at it from my perspective. I think we spoke, and I said, well, they're the wrong way round. The market's the wrong way round. I said, but probably because they were building up a short dollar position. So the market was probably short dollars, long euros, in anticipation of Trump getting in and spending lots of money. So all of a sudden, Trump got in with a good majority and got control of both houses, and the market went, no, we're the wrong way round, and so they aggressively sold euros and bought dollars on and other dollar-based currencies as well for the next probably 2-3 weeks, because it had such size to do. But what's happened now is that when Trump put in his tariffs, what it's done is it's actually weakened the US's position, and so that's the reason why you've now got this move, which we spoke about. I said they're the wrong way round. The market sometimes gets the wrong way round in such huge size because these guys on the small impactful news that you're trading won't trade. They'll just sit there and wait till the markets calm down. If they want to trade, then they'll put the money on. I mean, another one of the things that I always used to say to Brad is the concentration level that maybe a bank trader would have in comparison to a retail trader or somebody trying to become a retail trader is just that's the difference. One of the major differences, we're going to probably speak about it later, is one of the major differences is the concentration level. For example, I used to start work at say 6:30, and I made a joke about your fringe. How can you look at I would be sitting there glued to, let's say, 10 or 12 currency pairs, maybe more, and every single tick, half a tick, quarter of a tick, I would be aware of, and the concentration level of, and I would see something go out of sync. And when something went out of sync, you'd be waiting for something else to correct. A lot of that is now done on arbitrage models that are within the market, so it becomes very difficult. But you can still see real money moving, and it might be something like we use cable, for example, sterling against the dollar. If all of a sudden sterling is 21, 22, 21 and a half, 21.8, and it's not on 135, 21 and a bit, 20, it's doing nothing. And all of a sudden you see 18 offered, 16 offered, 15 offered, and it's moved fast. It means somebody's doing something. Now, what we'd analyse as bank traders would be, are they doing it because there's any news out, but we haven't seen the news out yet? Or are they doing it because they've got something fundamental to do, which might be a big order, it might be something related to something that's not even out yet, but I wonder if they're doing that because of that. Is there some news out on the, I can give you an example. I'll talk about the Liz Truss budget. I was sitting at home trading my books, and I'm up about £12,000, and I had a lunch. And then the budget came out, and I thought, yeah, I'm doing okay. The budget came out, wiped out £12,000 and another maybe £8,000. So I ended up being £12,000 up to £8,000 down. I squared up everything when I kind of analysed what the market was doing, and just went to the lunch. So I wiped out £20,000 in, let's say, a minute and a half, right? Of basically Liz Truss decided to do an unfunded budget. So these things happen because this is fundamental. That these guys have got the real money, the hedge funds, the corporates that are waiting around to sell their sterling, thinking that they might see X amount of big figures better. If she puts out a good budget, because it was going to be everyone was anticipating there to be some, because she had quite a big business approach to and growth approach to the markets, but she just did it with an unfunded basis. Which is what we're going into now with Rachel Reeves, is how does she fund a £50 billion deficit in the budget? How's she going to fund it? She can only fund it by taxation, which is why at the moment the markets are very, very anti what the Labour Party are doing. Mm-hmm. So what it is just a few little things that Brad wanted me to speak to you guys about, is to just look for some different ways of kind of making money within the ways that you're looking at the market, because it's not all binary. It's not what you see in front of you. There's so much other stuff that goes on than just than just looking at an impactful piece of news. I'd trade it the opposite way round. You know, what we were talking about, what you were saying, Tom, when you were talking about your buttons. I think you could sometimes even flip the button and just buy the dip. Say, for example, it's a quick sell, you could even buy it and then you just be getting out on the other side. But then that's the danger, because you're actually going against the news.
Yeah.
But the news doesn't impact these guys, not at that level. But the way that the hedge funds are going to put their trades on, they're going to put them on slow, but they'll take some back as well. So if they're a seller, they'll try and fool you. So they'll try and sell, and then they'll buy some, and then they'll sell. And also, it's when they pull orders. I mean, I work with some hedge funds that will pull orders. So what they do is they put orders in the market, and there'll be a buyer. But then what they do is you get close to their level to buy, and they probably see they've got all the information coming at them, because people want to do the trade for them. So they're getting lots of information about people that might be selling. They might be a buyer of say they might be a buyer of euro dollar. So they're seeing all this selling. They go, actually pull that order. You tend to find they might put the order in as a bit of a bluff. So everybody's kind of loading up and thinking, oh, I've got the order, I'm sitting there, I'm going to go in front of the order. Also, they pull all the orders and you have a great big move down, and then they come in at the bottom and go, thank you, we'll buy our euros there. And so the market gets sucked in, because they're ahead of the game. These guys have got, think of the systems they've got. You know, if you're BlackRock, you're going out and employing the best 100 people coming out of the best universities, the cleverest mathematicians, going to write your new programs, to update your software. They've got every single system going, and you kind of competing. You're trying to find a way of how can you compete. And the only way I'm sitting there thinking, we talk about this a lot, is how do you compete with intelligence? And they've got ultimate intelligence. They've got the most intelligent people in the world. I mean, listen, all of us are fairly intelligent sitting in this room. We're not going to get an interview at BlackRock. They're not going to employ us, no matter how intelligent we are, because they've already got, they're in there already, like paying people like $250,000 just to start off on a graduate training scheme, just to come in and see if they're going to be any good. They'll take 100 on a year, as all the big hedge funds do, and they're all fighting for the best talent out there, and they're coming into an environment where they're in the know about everything. Goldman Sachs was one of the big ones in our day. So Goldman Sachs, they're the Goldman Sachs Asset Management. I mean, these guys were super intelligent, and sometimes they weren't getting everything right, but when they did get it right, they got paid a lot of money. In fact, there was actually for about a period of about 10 years, like they'd come in, for example, you know, let's say Finn was working at Goldman Sachs and he's their top guy for 2 years. He'd probably get £20 million worth of bonus over 2 years by making $200 million for the bank. The next 3 years, he loses $500 million, they sack him. So effectively, net he's lost 300, but he's still earned £10 million in bonuses. So a lot of that happened as well, but that's been taken out of the market. They won't allow that anymore. There's so much money coming into the market under management. I mean, I don't know what BlackRock are running now. Is it something like 7 trillion?
11 trillion.
11 is it?
It's in the double digits, yeah.
Right, okay, so they were 7 trillion about 3 years ago, they've got 11 trillion.
I think they do,
Yeah, okay. Yeah, it'd be interesting because
They buy 800 million of BTC every day.
so you're looking at 11 trillion. What's the leverage on 11 trillion? So what's the leverage on that? They're probably getting close to 100 to 1, I would imagine. So work that out. Work that out. If you wanted to pay off so what's the US debt? Around about
35 trillion.
yeah, 35 to 40 trillion. You've got out. If you work out the debts, so on their leverage alone, BlackRock literally control the deficit. You know, and that's just one. There's obviously others that have got people that have got 2 trillion under management. You know, and what they do in all of they're just telling the markets where they're going, and we're sitting there as people within the market. We need to think like them, but thinking like them puts you into macro positions, like long-term positions, because they don't care. They're not getting out of any of their Wall Street anytime soon, but they might be. In fact, it might be why Wall Street hasn't done anything, but we don't know, because there'll still be people out there still buying. But I was a currency trader, so I specialised in certain currencies. So for me, I think you have to specialise. Yeah, so you're picking currency pairs, so you become experts at that. That would be one of the things I would say. Don't be thinking all of a sudden, oh, I'm an all trader today, right? Find out the correlations in your own markets. Don't all of a sudden, do you know what, I'm going to jump into US equities today. Tomorrow, oh look, sterling's moving, I'll be a cable trader, right? Pick maybe a little bit more than yen even. You know, maybe look at the euro dollar aspect of it. Like for example, if you see dollar yen getting sold, does that mean that, and you see euro yen just staying the same, but dollar yen's getting sold? Well, what's that going to tell you? If that basically it means that euro dollar's going to go up. And so what you do is you can get like something a little bit safer as a kind of a byproduct of the fact that maybe dollar yen's moving a little bit too fast to sort of encourage you to get into. So you can add a little bit more to it, but be an expert on maybe, I mean, do you trade Aussie yen? Now, Aussie yen's one of the biggest traded guys for these hedge fund guys. It's one of the biggest traded things they do, and mainly because of the interest rate differential there's always been, you know, in that. And obviously buying Aussie yen was the big, oh yeah, the markets, yeah, everything's good in the world, let's go and buy some Aussie yen. They used to sit there with, I remember doing a trade probably back in about 2005, where one guy, he literally sat there long of about 500 billion Aussie yen for the whole year, right? Hardly ever moved, but because of the interest rate differential, they made money, and they did a massive deal at the end of the year to take all their money. They literally were selling 500, you know, over a course of a period of time, they were just coming out of this market trade, but the market was so liquid at the time, so he literally bought at one level and sold near enough at the same level, but made an awful lot of money because he had the whole interest rate differential. I'm not sure what Aussie rates were at the time, I think it was a 4% difference. You know, and if you're trading leveraged amount of money, so effectively you work it out, he's actually, the capital, say for example he's managing 500 billion, well he's probably managing 100 billion, but he's turned it into a 500 billion trade. You know, so you've effectively got 100 billions for the client and 400 billions for your hedge fund. So yeah, that would be my thing, is find out the things that you can be the experts on. Research the times of the day you see them moving, right? Because you're going to find some patterns. You're going to start seeing, oh, it did nothing, it was like doing nothing. Then all of a sudden there'll be a movement, and it will move, and it will move in a little trend, and then there'll be a little bit of a consolidation within that little trend, and then you'll find another point in time where it will move again, and then you'll go, and then you can start monitoring those little movements, and then they become times that you're aware of during the day. You know, if those times are, it's definitely around about the 8 o'clock period, and it's definitely going to be around about 4 o'clock period. There's definitely some stuff that goes on at 10. Will it be midday? Will it be 12 o'clock, 2 o'clock? And the reason they changed it is because they were getting people were pushing the price against them, so they've changed the way they did it. They used to just do a 4 o'clock, but they now do different moments. And another thing to look is overnight markets hardly ever move, and the reason is that because there's lack of liquidity, a lot of these hedge funds they wait for the opening, and that opening will start around about 7 o'clock in London morning, where liquidity comes in to play, and that's where you start seeing the lead up to a move, especially in the foreign exchange. So if you start seeing, for example, dollar yen getting sold at 7 o'clock in the morning, and it's still happening at 7:20, 7:30, invariably that's going to be one of these guys putting on some size, and it's following the money. You know, rather than guessing where the money's going to go, sometimes you have to sit there, be neutral, and wait and see where that money comes in. You know, and then it all makes sense. You know, because you're trying to make sense of some of these movements. Very, very difficult. But if you get the timings correct, you might not even be looking to trade, but you might be able to find something. You go, do you know what? There's no reason to trade. There's no news out. You said, but I've just seen these couple of timings that go on during the course of the day that are making me some regular income. And that's what everybody wants to do. If you're a retail trader, you're just looking for a little bit of an edge. And the only edge that we can get on these guys, we're not going to get the intelligence edge. The only edge is that when they start to sell or buy, and we see it, and we can prove it, and we can prove that they're doing it over a certain period of time, and they will change a little bit, and that's where the research comes in. That's the edge that we can have, because, you know, let's turn around and put it in a little bit of a perspective. If you're playing football and you know someone's only ever going to shoot on his right, if that's the goal and they're only ever going to shoot with their right foot into that top corner and you're the goalkeeper, that's your edge, isn't it? He's done it 1,000 times, so I'm always going to dive up there and I'm probably going to make the save. And that's the same thing in the foreign exchange market. It's a little bit more predictable than you think, but obviously you have to have the concentration level to be able to stay in the game and pick those times out. So, and also just sorry, the one thing I think when I said it was bang on 4 o'clock and bang on 8 o'clock, they've now changed it and they now do it on 2.5 minutes before and 2.5 minutes after. So it runs over a 5-minute period. So fixes are now run.
Is that every day, Jules?
It will be. There's always a 4 o'clock. In fact, I met a guy that I used to work with who actually correlates these fixes for Midland Bank. So he works for Midland, and he used to work in Monaco. I mean, I'll give you an example. This is a guy that I used to work with, and we've been trying to hook up. And he used to invite me. He used to work at Midland Monaco, and he invited me to 2 years on the spin to come to Monaco and watch the Monaco Grand Prix from a flat that he had access to from one of the wealthy clients. And I could never go because I was always on a family holiday. Anyway, so we hadn't seen each other for a long period of time. We just managed to get together, and he was telling me a story about one of these clients, one of the clients that he had, came in one day and needed to buy £1.2 billion sterling against the dollar. So I was like, oh, that's a big trade for a little private bank. He went, the guy had loads of money. Anyway, he said, how do you want to do it? And Russell didn't really know how he wanted it. He said, well, look, I'll be honest with you, we just go on the algo. He put an algo on, and he bought the £1.2 billion 30 points cheaper than the market. So just to let you know, if I was sitting in a bank and I had somebody come in and ask me to buy £2 billion, that's a big amount, and I would be sitting there expecting to make a lot of money. Effectively, Russell managed to buy this guy's 1.2 billion, 30 points lower than the actual market. You know, some of those stories are very, very apparent. In fact, Stuart, who you've met, was telling me of a few where you know, sometimes it just depends, because where's the money? The money's coming. Probably the economic indicators at the time is the BlackRocks of the world are probably selling 3 billion. You know, so they're selling 3 billion and 1.2 billion. So that's why you have to be with this money watching.
The guy who wants to buy that much just accept that the price he's getting.
Well, back in the old days, they'd ask for a price. Back in our days, somebody would come in and they wouldn't trade it like that because there wasn't the algos didn't exist. The algos are something that have come on. They were around that particular period of time, but now they're very, very prevalent. So a lot of these guys, I would say 90% of these people now, they pay for access to bank liquidity, whereas before they got the bank liquidity for nothing and just used the price making services. So now what they do is the banks are all linked in. They're all linked in together. There's nobody, oh, this is my price. Everybody is linked in. There's a computer system going around all the liquidity, and all that liquidity is linked in.
I mean, they can see everything.
So you can't, they'll be able to see everything.
All the money.
You know, so, and people mess around with the orders as well. I used to do it all the time as a trader. People will put people keep talking to me, what's the system that they run which shows you all the amounts coming in?
Yeah, the order book.
The ladders, right? You know, so the ladders, for example, even when I was trading on a retail basis, I used to mess around with the liquidity all the time. So I put bids in. I put bids in when I'm a seller all the time, and so then people would be bidding above my bid, you know, to try and. But I'm not really a buyer; I'm a seller, so I'm just trying to create a little bit of noise to try and create. And I'm sure it exists today.
Yeah, spoof orders.
Spoof will be what you try to spoof the market, pretending you're a buyer, but really you're a seller. Obviously, if you get caught with it now, it's pretty dangerous, but it will still exist. It will still exist from the big corporates because they want to disguise. Why would you just come in the morning and go, I'm selling? So how they do it now is they sell and buy. They sell and buy it, but they sell and buying because they might have something to do, but they might not have as much as you think. So they might be overall, it's 500 million. But if I sell it and it comes down, I'll buy it back. And, you know, they've got some scope to trade with. They don't trade on like you guys are just trying to make, you know, like amounts of money per day. You know, they're just working at percentages. They're working at percentages that they're going to try and give to their clients at the end of the year. You know, they're trying to make as much money as they possibly can because It's the reason why there's so much money under management now, because when money was cheap from the central banks, people were borrowing money and investing in a hedge fund that will return them 7, 8, 9, 10%. Why wouldn't you? You're borrowing it for nothing off a central bank, putting it into a hedge fund, you know, through the bond printing that was going on at the time. So, but just a few, you know, a little bit of food for thought, that if you do your research correctly on the currency pairs that you trade, what are your currency pairs you trade? Or what do you trade?
I look at Euro USD.
Right, okay, right.
I do the same as the people.
So you're all looking at dollar yen?
Dollar yen or
I think we need
dollar, pound or euro basis currencies.
Okay, so you're looking at the majors?
Yes, I am.
Yeah, so the majors are good. The majors are good to look at, and there's definitely a lot of impact in the majors. But you just got to do the research and look at the timings. People don't just sit there and go, oh, actually, it's 20 past. They'll have a plan. They'll have a plan, and also it's because there's meetings as well. They'll have, these guys have meetings. The way that these tickets are produced is they'll have a momentum. I spoke about the end of the year momentum stuff. You know, when you see some major moves on all the big currencies, like probably the biggest fixes of the year on the 31st of December, and a lot of that is because people have to repatriate certain amounts of related to the equity markets. They have to repatriate certain amounts to pay out dividends. So you might see a big euro dollar sell because people will need to buy dollars to pay out dividends. Like for example, the stock market. Like for example, this year the stock market's it's sort of stayed up, hasn't it? It stayed big for the majority of the year, even after the Trump scenario. So there will be dividends to pay. So there will be a big fixing of some description, because at the end of the year people need to pay the dividends to. So you see bigger fixes in relation to all these people, corporates, hedge funds. Probably not real money, because real money they're just trading their money. It's a bit like, you know, if you've got £10 million and you know you want to sell it and buy euros for a couple of years, and then get that and buy them back. You know, that's real money, but obviously on a more regular basis.